You know, I think probably a lot of individuals watching the show right now, if they're still working and not already retired, probably have some form of a 401k that they're participating in, whether it's a 401k or a 403b, maybe a simple IRA, just depending on what their employer has. And a question that I'll get a lot of times in the office is typical 401ks and 403bs, things like that, will have some sort of a company match, an employer matching program, meaning you put some money in and the company will contribute some money as well. But the question that I'll get a lot of times is, Matt, you know, I have more money that I need to save or want to save and I can save. So is it better to put that extra money into the 401k over and above the company match, or would I be better off putting that money someplace else? What do you guys think about that type of question?
Well, if I could take this one, Jordan, I run into this all the time. And I think the best route to go there is, since you've got the plan already in place that's a taxable 401k or something that's pre-tax money, I always think that it's better to go ahead and diversify yourself with something completely different, where you're going to have some tax-free growth, maybe in some type of insurance strategy or some type of Roth plan if they qualify. I just think it gives you a little bit more diversification and flexibility once you go into retirement.
What do you think about that, Jordan?
I think kind of a good general rule of thumb is to see what the employer's matching. So if they're matching 3%, that's free money, and you wouldn't want to give that up. But maybe consider, like you said, Dustin, going with some different options, some insurance strategies, some Roth strategies, and contributing that extra money there so we do get that diversification.
Now obviously the benefit of the Roth IRA is as opposed to, let's just call it a 401k. You know, if you put money into a 401k, you get the deduction on the money going in. It's going to grow tax deferred, but then when you retire in the future and you start taking money out of that plan, you're going to have to pay tax on all of it, both what you put in plus the growth. The advantage of the Roth IRA, obviously, is you're funding it after tax, so you don't get any deduction today, but then the money's going to go into it. You don't have to pay any taxes on the growth along the way, and then once you retire and start taking income and distributions, you pay no tax on it. And then there's some other advantages, like you don't have to take mandatory distributions, things of that nature. So I really like Roth IRAs. The unfortunate thing, though, is that not everybody can contribute to a Roth IRA, because the IRS has certain income limitations. You have to have earned income. And if you and or your spouse make too much money, then you can't even use it. So there are some other options, though, sometimes that can be utilized. What are maybe some of the benefits of some of the other options?
Yeah, we've got a plan called the Rapid Builder. And basically what it's doing is taking after-tax dollars, or non-qualified money is what it would be called, and moving it into a strategy where we can grow with the market, but it's growing in a completely tax-free manner. So that when you go in and start taking money out later on for maybe an income or for some other purpose, that's going to be tax-free money that you're taking out of the account. Then when it goes to heirs and beneficiaries, as well as like a Roth IRA would, it's going to go to them completely tax-free.
And that's a really good point, and that's something that I really like to see. You know, a lot of times when we meet with individuals, they'll have almost all of their money or all of their money in a 401k or an IRA. It's never been taxed before, so that means when they retire, every dollar they take out is going to be taxed at whatever ordinary income rate that they're in. If we have some money in a Roth IRA or maybe some of the other strategies that are available to us where we can take tax-free income, what that allows us to do then is maybe take some taxable income from the IRA and some tax-free income from some of the other sources, and we can kind of make sure that we're not going into too high of an income tax bracket, right? Now, if everything's just in the regular tax-deferred account, we don't have any choice. We just have to take it out and we have to pay the tax. Now, Jordan, you were making a good point earlier that if a company has an employer match, you want to take advantage of that. That's free money. There's nothing, even if we can grow the money tax-free, there's nothing better than doubling your money, right? So maybe contribute to the 401k up to your company match and then take the difference and invest it someplace else. Are there any other problems an individual should be aware of as far as having money invested in their employer 401k?
Yeah, I think with 401ks, a lot of times individuals don't realize once they reach a certain age, they can actually do what's called an in-service rollover. So that means that even though you're still working with a company, you could roll the funds into an IRA. And to Dustin's point, you could add some more diversification and really choose a different investment. So that's a conversation we'll oftentimes have to see, is that a different route we could go?
Because inside of your 401k with your company plan, you're limited to what they choose as your options. So a lot of times once you get close to that retirement date, they may not have the option that you're wanting to move into. So that in-service distribution is a great option if somebody's getting close to that.
Yeah, that's a great point, because typically mutual funds right now, most of the time, the only option you have are mutual funds, right? And different plans will have different mutual funds. Some are better than others, but that's for the most part, that's the only option.
Yeah.
And as you get close and into retirement, that might not necessarily be the best option.
Right.
So checking and seeing if you can do an in-service distribution is kind of a good idea, because maybe you can take part or all of that 401k out now. Even though you still work there at that company, you can typically still contribute to that 401k plan. But maybe you can roll those dollars someplace else. Maybe get them into an environment where you have more diversification, maybe start to get prepared for income and distribution if you're planning on retiring soon. I think a lot of people don't realize that that is an option.
Yeah.
Now, again, you want to make sure that you can do that, because some companies will allow it and then other companies won't. But if it is something that you can do, it's definitely something that we would recommend, correct?
Definitely.
Yeah.
Okay. Well, if you have questions about whether you should contribute over and above your company match, or if you already know that you don't want to do that, but you just don't know where it's best to invest those dollars, then feel free to give us a call at the office. You can meet with myself, Dustin, or Jordan. We would be able to help you out with that type of situation and analyze it.
So if you needed to pull some money out and you wanted to go on a vacation, or you wanted to buy a new toy, maybe a boat or a new car, that's going to be flexible and allow you to have that option. So the two most popular methods of creating income into and throughout retirement are going to be dividends and interest, as well as annuity strategies. Now, people hear us use the term dividends and interest, and a lot of times we find that they don't even know what that means. So where they come from is dividends are going to come from some type of stock position or some type of equity position that you own. So let's just say, for instance, we have a preferred stock that's worth $100 and it's paying a 5% dividend. Well, we'd be receiving a $5 dividend each year off of that position. Where an interest would be, actually, if you loan someone money, you make interest off of it. So the way that works is, if you buy a bond, for an example, the bond would have a coupon rate, which is your interest rate, and that's how much you would make per year off of that position. So when we add these two up, that's how we create income. So we would have some dividends coming off of stocks and some interest coming off of bonds. So there's some pluses and minuses to that strategy. So one of the pluses, we could get, let's say, up to 5% a year in income off of that strategy. But that's not a guaranteed strategy, and it's going to be a little bit volatile. So one of the other positives is that it's very flexible. So if you needed to pull some money out and you wanted to go on a vacation, or you wanted to buy a new toy, maybe a boat or a new car, that's going to be flexible and allow you to have that option. Some of the drawbacks, or we're going to say negatives, we got some risk. So if we look at a year like 2008, when the market was down significantly, well, if your income was based off of dividends and interest, it's likely that you lost a significant portion of your income and probably aren't back to where you were before it happened, even today. So if we look at portfolios that are set up that way, there's a lot of risk there. So very flexible, but again, it's risky. The other income strategy we could employ would be something using an annuity. And annuities, what that is that's a contract between you and an insurance company, where you give them a certain amount of money and they agree to pay you interest over time. And then it allows you to turn a guaranteed income strategy on that'll last your lifetime. So again, there's some pluses and minuses to that strategy. The pluses is you can get somewhere between 4 and 6% income guaranteed for the rest of your life. So that can be very attractive, but basically there's no risk at all there as far as losing your principal. So you have a lot of safety. One of the negatives there is it's not going to be real flexible. So once you open the account and you've turned the income strategy on, you're kind of locked into that income for the rest of your life. But you're basically trading off a little bit of flexibility so that you can have a guaranteed income stream for the rest of your life without risk of going down. So if we take a look at a optimum portfolio, you're going to use a little bit of both of these inside of it. So let's just say, for example, that we have $1 million portfolio. So let's say it's $1 million, and we have an individual that's 70 years old. So he's 70 years old. We would take about 70% or 700,000 and use a strategy we're going to get some guaranteed income. So we could take 700 and we would produce $35K per year off of that account. That's guaranteed income for the rest of their life. Then with the balance, or 300,000, we could employ a strategy that has a little bit of volatility there. It's still going to be using safe positions that have a lot of consistency and a long history of good earnings. But with that 300,000, we're going to be able to produce about 15. So, in income. So together, with both of these accounts, we're going to produce about $50,000 a year. We've maintained flexibility and liquidity in case we wanted to go on trips or needed to buy some type of toy, but we've got our guaranteed strategy in place as well. So if you have any questions about how to optimize your portfolio to make sure that you still have some liquidity, but you also have some guaranteed income, please feel free to call our office and/or visit our website.
There is a lot of talk about shorting, short selling, or being short, and I really want to build a foundation for this. I think that it's often misunderstood, and in some circumstances, shorting can yield good returns. On this segment of Strategic Wealth University, we're going to be looking at a couple of commonly used financial terms, but rarely ever explained simply. These terms are long and short. Now, what do I mean by long or short? Long means that an investor has ownership in the underlying stock and anticipates that the stock will rise in value. You'll commonly hear the term long on equities, right? So for example, Jim holds 30 shares of company ABC. He's long on equities because he is, for one, holding a stock which is an equity, and he's long because he maintains an ownership interest in the underlying stock. Now on the other side we have short. There is a lot of talk about shorting, short selling, or being short, and I really want to build a foundation for this. I think that it's often misunderstood, and in some circumstances, shorting can yield good returns. Now to short something, it really means you owe the underlying investment at a certain price in the future. I like to explain it as making an investment with the expectation or belief that the underlying investment is going to decrease in value in the long term. Now, when can this be appropriate? Sometimes this can be appropriate when an investor sees a sector of the market where there's an overvaluation, and the investor sees that the investment has a high probability of going down in value. So for example, let's say Dave evaluates company ABC and he sees that it's trading above its true value, or what he believes its true value is worth, and he really feels that it's going to go down in value. So he shorts company ABC, and he can make money as the stock goes down in value, or make money on the downside. So a lot of investors will short the market whenever they believe that a correction is overdue, or if they think a commodity like corn or oil or gold is overvalued. So something to keep in mind is this. When you purchase a stock or you go long, you create an environment of risk because the investment, it could go down in value, right? Now, if you short something, you're doing the exact same thing because the investment itself, you're shorting it, right? It could rise in value, which would in turn decrease the value of the short investment because the ultimate goal of shorting something is to make money as it falls in price. So let's take a look at an example of long and short. So Pat buys one share of company ABC stock at $100 a share, and she decides once the price reaches $115 per share that she's going to take her gain and get out. Right? Pat would, of course, made a 15% return on her portfolio. Now, on the other side of this, Pat wants to short company ABC because she believes that it's going to go down in value. So she again purchases company ABC at $100 a share, and the price goes down to $85 a share. Now on this side, Pat would have again made a 15% return. So she again decides that she wants to take her gain and get out. So this is really a simple example of how an investor can go long or short on an investment. Now going long or short on equities or any other investment, it really requires skill, investment savvy, and a fundamental understanding of how the stock market and its overall landscape operates. So if you would like more information on long and short investments, please give our office a call or feel free to check us out on the website.
Is basically the economy right now is very weak. Okay, it's growing a little bit. Things obviously are better than the financial crisis we had many years ago. However, it's still very, very weak. Let's talk a little bit about interest rates and why I really believe that the current interest rate environment in which we're living in, unfortunately, I don't think is going to go much higher anytime soon. And obviously what I'm talking about are the decisions that the Federal Reserve is making. We know recently they increased interest rates just a little bit, but we're still basically at historic lows, and I think they're probably going to stay there for the immediate future. And basically what we've got here on the board is we've got 7 reasons as to why I feel the Federal Reserve will keep interest rates right where they are for at least a while longer. So number 1 is basically the economy right now is very weak. Okay, it's growing a little bit. Things obviously are better than the financial crisis we had many years ago. However, it's still very, very weak. Right now, it's growing less than 2% per year. And basically, economists and experts have come out and said that next year it'll probably be around 1.5%. So usually you have rising interest rates when the economy is growing at a good pace. Obviously, right now it's just not. Commodities as well. So commodities are going to be things like gas and oil, gold, silver, coffee, things of that nature. Commodities are struggling, and usually commodities are struggling right now, but usually commodities are a signal or a sign of inflation, and right now we're just not seeing it. So if commodities weren't struggling and they were going up in price, if the gas at the fuel pump was going up, that would be a sign that commodities were doing good. That would be a sign of inflation, and then that's again a reason why the Federal Reserve will increase interest rates to try and slow down or cool the economy. But right now we're not seeing that. If you look at the overall global economy, the global economy is actually worse than the U.S. economy right now. You know, even though we're struggling, if you take a look at Europe and some other areas around the globe, things are much worse than what we're experiencing here. So that's why you still see individuals buying into our treasuries and things like that. But since the global economy is worse than the U.S., rate hikes, what they will do is they will increase the cost of imports into the U.S., which obviously would not be a good thing for the overall economy. So another reason why we can't really increase interest rates. If you take a look at number 4, like we just mentioned, it's a global economy, and the IMF, you may not be familiar with that. The IMF is the International Monetary Fund. They basically came out and they encouraged us not to raise interest rates. They said things are so bad all around the globe, even if we felt the need to raise them here in the U.S., they're putting pressure on us not to do that. They've asked us not to do it, and so far we've adhered to that. Next, we take a look at, we don't want to have another 1937. So most of us are going to be too young to remember 1937, but what happened in 1937 is we'd gone through a pretty bad crisis in the economy and in the stock market, and things finally seemed to be getting a little bit better. So what the Federal Reserve did is they raised interest rates, and what that did is that forced us into a massive recession where the stock market ended up losing about 50%. And a lot of economists will blame the Federal Reserve raising interest rates, and will blame that, and will say that that's what caused the market to go through that type of correction. So obviously the Federal Reserve doesn't want to make that mistake again. Also, right now, there is no risk in waiting. So why not just kind of wait it out? Things don't seem to be changing very much. They've improved a little bit, but nothing's really happening rapidly. So what's the rush, basically? Why don't we wait it out and see if we need to raise them in the future? There's really no reason to force interest rates higher right now, is basically the attitude of most of the individuals that are on the Federal Reserve Board. And then last, and I think personally, probably one of the biggest issues and one of the major reasons why we're not increasing interest rates so far, and I don't think that they're going to go up really anytime soon, is if we started to raise interest rates, we could no longer afford our debt that we have to pay and pay back as a country. So if you take a look at it, interest rates historically average around 5 or 6%. I know a lot of individuals remember that back when CDs and savings accounts, things like that, used to pay a lot better interest than what they are today. So right now, depending on the day, and depending on when you're watching the show, interest rates are the 10-year Treasury is around 1.5% as an example. Depends on the day that you look at it, but it's hovering around 1.5 to 2% right now. Well, historically speaking, it's usually 5 to 6%. If we were to get back to those levels of interest rates again, we couldn't afford our debt. Obviously, everybody knows we're $19 to $20 trillion in debt right now, and we have to pay interest on that debt. Well, right now, the interest that we have to pay, and when you take a look at the federal budget, is based upon the 10-year Treasury being around 1.5 or 2%. If interest rates were to go back to historical norms of 5 and 6%, how are we going to pay back those interest rates? Basically, if you take a look at the current budget, if we get back to historical norms with interest rates, servicing the debt would be the single largest expense in the budget. Bigger than all the entitlement programs, bigger than the military, the single largest expense. Obviously, we don't have that money, which causes us to run additional budget deficits, which of course increases the debt. So I think that the Federal Reserve for the immediate future is going to do everything they possibly can in keeping interest rates as low as they can. So this is why if you have money invested in savings accounts or CDs, obviously you don't have to worry about losing any money on that from the stock market losing value, but you're going to be losing purchasing power. Even though inflation is running much lower than historical norms, it's still having an impact. And I don't think that you can really afford to continue to wait for interest rates to go higher. You've got to take a look at some other options that are out there in the marketplace. And the good news is there still are different options available to you that we can have some sort of a safety net on it, but you'll earn a better rate of return than what we're seeing right now, because I don't think the interest rates are going to improve anytime soon.